Yeah, well, I think missing the traps is actually first thing is the key to yield investing, because if you actually buy a stock and then it cuts its dividend 100%, then not only are you going to get no income, you're also probably going to lose 20-30% on the announcement of no dividends. What are the features of these companies? Well, for a start, they tend to be stocks that are falling share price. I mean, the interesting thing is, how do you get a high yield stock? In the case of Myer and Metcash, how does yield get to mid to high double digits or teens in percentage? It's because share price has fallen 50% or 60% in the last 12 months. So that's a dead giveaway. Why has the share price fallen? It's because basically their underlying business is unsustainable. They're suffering losses, or they've got significant reductions in revenue, etc. That's what happened in both those sorts of cases. So you're looking for what's happening to the business, but the share price itself can tell you some of the things. If it's falling rapidly, I use the term "don't catch a falling knife." It's probably too early to buy into those sorts of stocks if their share price is falling significantly. You also want to look at the level of their dividends. Are they sustainable, or is their payout ratio too high? If they're paying out 100% of dividends or more, then that's definitely unsustainable. So you want to look at those sorts of things. Look at the type of business, the cyclicality, etc. Cyclical companies are far more likely to cut dividends than stable companies. And Myer is sort of a cyclical company because it's in that consumer discretionary type level. It's interesting, Metcash isn't. It's probably more tended to be a fairly stable industry, but we've seen high competitive pressures in that sort of area at the moment, with Aldi coming in and Woolworths, etc. So it's a tough business in that sort of area, and they're not doing that well. I don't think Aldi's going to be that big a threat in the short term to Wesfarmers and Woolworths. I think for Woolworths' case, the threat is Masters. What it's done there, I mean, it's blowing away $200 million a year, basically losing $200 million of the hard-earned money it's getting out of the grocery business. So, I mean, its real issue is to fix Masters, and whether that fix is to sell it or close it down, or get it better, or what have you. But that's probably their biggest task at the moment. Wesfarmers, I think they're doing pretty well. They're actually also able to, have been increasing market share versus Woolies at the top end. Well, I mean, one of the areas that, you've got a balanced portfolio that you want. You want to generate income, but to me, if you go into equities, you also want to generate growth. And to some extent, it's a blend of getting high current income, but also growing future income as well. You want to go and invest in equities to grow income over the future. So what you've got to look at is not just a portfolio that's very focused on income, because something like Telstra has basically only raised its dividend about once in the last 10 or 12 years. You need companies that grow income year by year. And so an area that's probably overlooked often for income would be, say, healthcare, because it is typically fairly low yielding stock. But good healthcare companies have actually grown their earnings substantially over time. That's grown their share price, and it means that their dividends are growing as well. So, I mean, we actually hold stocks like CSL in our portfolio. Now, you don't own them for today's income, but you do own them for future growth in income.